Major funding for this program has been provided by grants from Bank of America, Merrill Lynch, and Perfect Building Maintenance, New York Community Bank, All Nation Renovation, Kilroy Architectural Windows, New York's Window Company, Greenberg Traurig, LLP. Additional funding has been provided by grants from AVR Realty Company, LLC, Briarwood Organization, Capital One Bank, C.B. Richard Ellis, Cushman & Wakefield, Dime Savings Bank of Williamsburg, Eastern Consolidated, Hal Fettner, Durst Fettner Residential, Stephen Napolitano, First American Title Insurance Company, Friedman, LLP, Gemini Real Estate Advisors, LLC, Genova, Burns and Gian Tomasi, Grubb and Ellis, Investors Savings Bank, Jack Joffa and Associates Real Estate Consultants, James D. Kuhn Real Estate Institute at Syracuse University, Madison Realty Capital, Markham, LLP, Marcus and Millichap Real Estate Investment Services, Margolin Weiner and Evans, LLP, Massey Knackle Realty Services, M&T Bank, Meridian Capital Group, the Moynihan Group, Newmark Knight Frank, Orphanides and Associates, Siami Development, Inc., SJP Properties, Sterling and Sterling, Inc., RAL Companies and Affiliates, LLC, Spandrel Property Services, Urban American.
January 1, 2011. Where are we going to be? What's the economy going to look like? What's the state of the market? What's real estate? What's really going to happen? I really am not the one to answer that question, but perhaps my four guests today will give us their insight on where they see 2011. My guests today include Gino Martocci, who's the president of New York and Long Island for M&T Bank, Joe Grano, chairman and CEO of Centurion Holdings, Scott Shea, chairman of the board of Signature Bank and partner at Brunerian Partners, and last but not least, my buddy, my good friend, Jim Orphanides, who's president of Centurion Holdings and former chairman of the board, CEO, president of First American Title Insurance Company in New York. So, wise old friend Mr. Orphanides, how do you see 2011?
Well, Michael, you know I've always been an optimist.
And me, the pessimist next to you.
But I still am going to say that 2011, I'm going to be worried because I don't see the return of the jobs that are desperately needed to be made available to the people that are really unemployed and out of work right now. The people coming out of schools right now need some encouragement and need some opportunity. New York can't absorb all of the job market. This is a very big country with a lot of special needs all over the country. I'd like to see us really invest properly in the inner cities in the states that have them, and the towns and the municipalities, and start to work more closely with local governments and trying to really encourage growth in job markets there. It's really all about jobs. It always has been all about jobs, and it's going to continue to be all about jobs. And until we get that answered properly, I'm not optimistic about the growth of the economy in the next year.
Joe?
I'm cautiously optimistic. I think we might see a 2% GDP growth, which most people would not consider very good. I'd be happy to take it right now if I knew it was coming. I think we have a kind of a shaky global economy. You've got the possibility of another systemic risk in Europe between Portugal, Spain, Ireland, which everyone's reading about. You have a potential of a real estate bust in China. And as Jim alluded to, here in our country, real estate has to be stabilized. We have to get people back to work. 9.6% unemployment rate really is 15% if you talk about those people off the rolls and those who went part-time. And I also don't see confidence. In America, confidence is very important. That's perhaps the most important stimulus program we could do, is somehow get leadership, some solutions, and restore confidence in our nation.
Scott, you were also, I want your opinion, but you were also talking about, the residential market. So I'd like your focus a little bit on that and everything.
Sure, but the headline is, I think we're in the midst of 7 lean years. And we're maybe in year 3 of it in 2011. The history of financial crisis-induced recessions is that it takes a long time to overcome the deleveraging that needs to happen to rebuild balance sheets. Unfortunately, I think that we've created a great deal of additional risks to the outlook by virtue of the fact that we're trying to take all of these actions to forestall those 7 lean years. Quantitative easing, which are right now in the midst of a $600 billion Fed experiment to see if they can shorten that time frame, is a risk. I hope, for the sake of the country, that it turns out well.
Yeah, but look at all the printing of the money. Look at all.
Well, that's why I think that that we have actually a less certain environment than we normally would. In that, if you told me a year from now that we're going to be in a double dip, I could believe that, and I can get into that later. But if you also told me that a year from now we were going to be experiencing 6% inflation, 7% inflation, I could believe that too. So we're not sort of letting the process play itself out. We're trying very hard to induce, as a country, an additional asset bubble, be it the stock market, be it the bond market, and that is creating additional financial risk for the country because many people who are in asset classes right now actually don't want to be there. They're in those asset classes because the underlying level of interest rates are so low.
Gino?
I guess I would echo what Joe said. I mean, I think I am cautiously optimistic. I think under the surface, in certain segments of the economy, things are better than they appear. I think we have, but that being said, I think we have long-term structural problems in this country, which is what Jim was mentioning earlier, that there seems to be no political will to tackle. And then when you hear things like the uncertainty about the tax structure for 2011, the possibility of eliminating of the mortgage interest deduction and the impact on the housing market on that.
Also the mortgage interest and the home equity
and
deduction also.
What seems to me to be just a highly divisive political class that can't rally around the structural problems. This to me is a dramatic risk to the downside. I do think that the underlying strength of the country, and somebody said the regenerative power of capitalism will ultimately prevail. But it's going to be there's risk that political leadership could forestall.
You know, we were talking prior to the taping a little bit about the cities that are improving, and I had said that I heard the president of Douglas Emmett, and Scott concurred with me, that there are 5 cities or 4 cities that are really improving. Manhattan, and let's look at Manhattan. I'm not saying Brooklyn and Queens. I'm saying Manhattan. I'm saying Washington, D.C., Boston, San Francisco, and Los Angeles, and many people are even dropping off the Los Angeles situation over there. But the rest of the country, you would bring up Oregon, other places, they're not leasing office space. They're not selling houses that fast. There aren't that many jobs. I mean, what are you saying? These are 5 different markets.
I know all of the men in this session today reasonably well, and I would say that all of us know that the hard work that we will try to do is not going to be enough to stimulate everybody around us, but it does start with all of us. It starts with everybody. Work is not something that we should look at as anything other than a great privilege. Most people that work today are extremely privileged, even if they're taking less, even if they're working harder to stay in their jobs. Whatever it is, whatever it takes. This is the United States of America. Whatever it takes for us to get ourselves back at work and get our people going and having people confident and positive, which Joe talked about, which is the real issue here. Attitude is everything. Let's start getting together and finding the ways to solve these problems.
I'm going to give you, you talk about putting work. I'm going to tell you specifically with regard to office leases today. Rents are down, and I recently did in this report that Manhattan's rents are $56 per square foot from a CB Richard Ellis, 26th in the world on rents. But let me tell you what's happening. Today, tenants are renewing spaces for less money than they were in the past. And what's more important is they're taking less space. They're taking more efficient space. Proskauer, who was landlocked at 1585, had 400,000 square feet. They signed a 20-year lease to move to 11 Times Square for only 400,000 square feet. They're making it more efficient. There are no longer, I mean, I've been up to your office. There's smaller offices. There are smaller offices. There are smaller secretarial areas. There are no more law libraries because of the situation. There's a lot of changes. So, when you take that into effect, the economy,
What you just described is deleveraging. That's what they're doing. And smart business people will deleverage when they have to. The more important component in real estate is capacity utilization rather than the rental rate. And I think that we learned some good lessons at the end of the 80s. But look, the bigger issue, in my opinion, is that as a nation, and particularly the political arm of our nation, is not solution-based. You turn on the TV, and all you're looking at are postmortems. Who did it? Let's get this person, let's grill this person. Congress is playing Pontius Pilate. They had nothing to do with the mortgage fiasco, and we all know they did, enforcing mortgages to people who shouldn't or couldn't afford them. We're not focused on solutions. We have to deal with the real estate foreclosures and a decline in real estate values because property taxes are the lifeblood of every community we live in. We don't get that right, we're going to exacerbate this problem. We don't get people back to work, you're not going to get consumption back. 70% of our GDP is consumption. And we have this overhang of debt. In 2008, when Obama came in, the deficit was $259 billion. Today, it's $1.3 trillion. Our national debt, our total debt, was $10 trillion. Today, it's 14. $1 trillion since 2002 is because of the war. We're up $3 trillion net in debt. You can't keep printing this money. It's around $47,000 for every human being in the United States, that liability. So we've got to start focusing on solutions. I don't know if any of you subscribe to the Mayan calendar where we're supposed to have Armageddon in December of 2012. I think those priests 4,000 years ago looked into the future and looked at the U.S. Congress and said it's over. Because what they've done is they're suppressing the economy and our ability to work out of it. The legislation is insane, in my opinion.
Now, we were talking before, I was bringing up the cost of health insurance now with claims, with Obama land and all the rest, and Scott was mentioning that the bank had to change their coverage to save money. I mean...
Well, I think everybody's looking
No,
at that.
I'm saying it's not only the bank. Everyone's looking for an alternative to reduce the expenses. But these are categories, and the working people... we don't have enough affordable apartments. We have a lot of problems.
Well, one thing that I was mentioning, and I think it's apropos to both what Joe and Jim said, which is a confidence issue. One thing that I look at very carefully, wearing my Ranieri hat for a minute, is foot traffic at open houses on residential real estate. And what is amazing to me is that foot traffic in almost all, outside of New York, outside again a few areas, foot traffic is down dramatically. That's the leading indicator, the first leading indicator of whether people are thinking about buying houses, apartments. And so it's not only that drives down real estate prices or has a depressing effect. I think real estate prices could fall, residential real estate prices could fall another 5 to 10%. But it also is an indicator of, does this family feel confident enough to make a commitment to the future to buy a house? Do they feel good enough about their jobs, about both of their spouses' jobs? And are they willing to set roots in a community?
I believe last year there were a number of reports and comments issued that more people, it's no longer the human desire to own a home. People are renting as opposed to buying because they don't see the appreciation. People were buying because of this crazy appreciation that people expected. I'm going to buy that apartment. 4 or 5 years ago, apartments in New York City sold off floor plans. Nobody cared about. Now they say, I want to see the finished building. I want to see that the landlord is structured the same way you want to sign a lease. You want to make sure there's a stability. You want to sign a lease with a REIT as opposed to a private lender, private buyer.
But Scott's point is so important. Look, We were always criticized as a nation for not having a savings rate. Today, our savings rate is 7% because people are scared and they're saving money for the future. But the savings account in the United States was the home. The American dream was the home. It always went up. Now I retire, I'm going to sell it and live off the proceeds. Well, now that it's declined, people are scared. It's this lack of confidence. What we need to do, go back to the old VA loan when I came out of the service. Let FHA refinance that house, but give it an assumable mortgage for 7 years. People will buy the mortgage, not the house. The house value will go up approximately $50,000 just by having a 7 year, for 7 years, I can buy that mortgage and adopt the assumable mortgage. Put a 50-year amortization schedule on it. When you lease a car, you don't base it on the cost of the car, it's on a monthly payment. But if you were to go to an assumable mortgage on these refis, people will start buying just for the mortgage.
Talk about lack of will. We put $140 billion into Fannie and Freddie, and no one's yet even proposed from the government the plan for an exit strategy.
There's so much confusion in the legislation, and you started talking about medical costs. Well, we're going to get hit with a 3.8% tax on this Medicare program, and it's going to, for the first time ever, be assigned to investment income, both dividend and capital gains, which effectively reduces your take home if they go to a 20% rate, 10% less. What does that do for consumption? So they have these countervening policies that are suppressing our ability to come out of the malaise. And
So
that's the problem.
Here, I got to pose this question to the two bankers over here. So how do you look at this when people come to you if they want a commercial loan or if they want a real estate loan?
Well, we're actually as busy as we've been in a
You
long
had said to me
in a long
you're
time.
busier on commercial real estate than you've been like fivefold.
It's a huge amount of demand right now, and fortunately, we're sticking to our underwriting principles and we're sticking to our relationship business model, which we've always done. We source all of our business really from relationships, and it's working for us. We're cautiously optimistic, but we are making sure that the right amount of equity with the right sponsors. We're not taking flyers, so we're out there doing it, but we're doing it in a way that's very, very disciplined.
And you?
I would echo those comments. I mean, we're sticking to our underwriting standards. I mean, one thing that I'm particularly proud of is we released last quarter's results, and our non-performers on a just about $11 billion balance sheet were $33.8 million. So about 30 basis points, if you will, on an $11 billion balance sheet. And that's not because we don't make loans. We make a lot of loans. We've got a $5 billion loan portfolio. A lot of that's in commercial real estate, primarily multifamily. But it's by sticking to underwriting standards. It's by having relationships, not doing one deal with folks you don't know. And if you follow those sort of fundamental paths of multi-tenanted, cash-flowing real estate, not going crazy and using speculative numbers, you can do okay.
I'm going to give you a situation. Gino and I always talk about this because when he does multifamily, he's higher than you. His rates are higher than you, but the GSEs. Okay, these government and certain sovereign bank and other people are lending money at under 4%.
To luxury high rises in Manhattan.
That's right. I mean, I
For
remember,
affordable housing,
and my friend
under
Joe
the affordable
Ficalora,
housing.
and I always say, how could Fannie Mae put out $158 million on a luxury rental building? That's not the mission of Fannie and Freddie Mac. That's not what they're supposed to do.
At 4% for 10
At
years.
4% for 10 years.
Well, we're subsidizing.
And wait, I'll give you worse. What is Stuytown? Stuytown is the exact example. The lender is Fannie and Freddie on this situation. So, something has to give. I mean,
You're describing banks that lend money to people who don't need it.
Now, that's right. But
It's the low end. That's 60% of our employment come from sole proprietors.
But you've been in the market for years. UBS, Merrill. So the market's at about 11,000 now. Where do you see the market in 2011?
Pretty close to where we are. I see a fluctuation of 5% either way. But because I'm concerned about these suppressive tactics around the world, I would advise clients 70% very, very safe.
Bond portfolio?
Cash equivalents, muni bonds, high yielding stocks that have good dividend coverage. in my own case, gold and silver. At the other end of the barbell, very aggressive. Biotech, private equity, nothing in the middle. There's no reason to be in the middle. So if we get a discernible trend, you have dry powder. No matter what happens to the market, if 2 out of 8 positions on the aggressive portfolio do well, the other 6 can go to zero.
And what
You make a lot of money.
What about you, Scott? What do you see? You've been in the market, Solomon, Lou, and everything all the years. Where do you see the market in 2011?
Well, I actually, again, would echo a lot of what Joe has said in terms of I do think that a barbell strategy in this environment is a good idea. Of course, the safest investment is a signature money market account.
Below $250,000.
Thank you. Good, Gino, that's it.
No, for as much as you want to put in. And but what I'm stressing to people is a lot of diversification. I think you need to be in the dollar. I think you need to be in foreign bonds. I think you need to be in U.S. equities, foreign equities, and I do think a little bit of commodities, gold or the like, is a good idea. I think for the bulk of folks, though, I would say for individuals going into funds is not something that I recommend. I would recommend for most individuals to be in fund of funds or to be in diversification, because into well-diversified private equity, because there's too much alpha risk, there's too much specific risk for an individual.
This is interesting. I remember when I was with Apollo, and I worked in the Time Warner Center, and they had a First Republic branch. And I was friendly with the guys downstairs, and it was 2007, 2008. They told me that certain people who lived in the Time Warner Tower went downstairs and they said, "We want cash." They were so scared of the market, they literally wanted bucks. Currency. They wanted currency to keep themselves over there. They were totally petrified of the market and what was happening. And, the market went down to 6,000. It's a big question. My own sons say, "Dad, what should I invest in?" And I'm not a guru in this market. And I think you've given some advice. But how do we jumpstart the economy? What do we do? Because you grew up in Chicago. I have a son in Chicago. When I go to Chicago, I don't believe that the sales tax is 11.5% when I go to a restaurant. I can't believe it. But New York City's not far away. It's at 9%. And the only reason that you in the Garden State people go to retail is because there's no sales tax on clothing.
And a lot of people from New York go there.
That's exactly what I'm saying.
Let's focus on employment for a moment. The Obama administration came out with a $50 billion package to allow CapEx or investments in capital equipment and the like. You can now amortize it in 1 year rather than 7. If you look at the low cost of money and you were to present value that, it is a hiccup. It does nothing to help this economy, in my opinion. Take the same $50 billion, go to the Fortune 1000. If you have 30,000 employees, UBS, if you hire incrementally 1,000, I will give you an investment tax credit of $10,000 per employee, or $10 million. 3,000, $30 million. If 1,000 Fortune 100 companies do that, the cost is $10 billion, and we hired 1 million employees. Now, those 1 million employees are going to pay at least $10,000 in taxes that they're not paying today. It costs the taxpayer nothing. Go to the sole proprietor and say, if you have 150 employees, you go up 10%, we'll give you a $150,000 investment tax credit, which affects your earnings. And that's where you'll get America reinvesting into employment.
But I think, I do remember when, maybe 15, 20 years ago when there was the investment tax credit and people were applying the investment tax credit.
You have to have productive things for them to do, though. And the productivity rate goes down. I mean, it's assuming that you can put them to work productively and they can make money.
That's correct. Mm-hmm. That is correct. But I think it's more an issue.
But at least it's in the private sector's hands.
Pent up demand right now. I mean, people have the lever.
It's to start to crank the old-fashioned
But it's the confidence. The government is giving me an investment.
Prime's the pump.
To hedge the bet.
I'd like to reverse, though. Joe's talking about the Fortune 1000.
Let's get to the smaller.
Let's go to the 50,000 small businesses that can't go to great banks like these two and other banks to get real small business loans today.
Trying to go to the SBA. You'll get turned down tomorrow.
We're one of the, we just won awards for being one of the most productive SBA lenders in the country.
Well, that's
all of
you
our
should be-
communities. We're
If
number
you
one.
do anything, PR
Nearly
that
all of our
because that's important. That's important. But many people, Joe and I see a lot of different businesses coming in our doors because they can't get financing anywhere. There is no cash, as you just said. Cash is king, and there may be a lot of cash sitting on the sidelines, but it's not being deployed to the small business guys right now.
I think because of where these two banks are, there may be an exception, but he's right. Lines of credit, even with sole proprietors that have never skipped a payment, are getting pulled across the country. Now, you want to access the Fed window at 25 basis points, zero cost of money, they should be saying to the banks, okay, 50% of that takedown has to go for mortgage origination, refis, and lending to small businesses, or we're going to charge you 2.5 points. Make a choice, pay or play. And
Stimulate the economy with
you'll
the
stimulate.
tools that
People
we have.
will do what they're paid to do.
I don't know, we're not in a position where we're turning down good business. The
No, you're-
difference is underwriting.
Yeah,
You know,
standards.
look, you've got to be conservative to put the money out. A lot of people just don't qualify.
Understood.
That's a very big problem, and I would say, look, we're open for business and making small business loans and commercial loans, and our loan portfolio has actually grown, and again, from publicly available information, it's grown by more than a quarter over this year, so whereas the average bank has actually saw a decline in loan growth, we've actually grown, not a decline in loan growth, a negative growth. We've grown by about a quarter. But having said that, I would be very worried to get the government deeper into the credit allocation business, because that's how we got to where we are today, was by over-allocating credit to mortgages. I think our issue is we need to, not our issue, I think our issue as a nation is we need to lower regulatory barriers and free up
agree with
capital. Capital goes where it's welcome, where it's treated well, and where it's compensated. And that's a universal rule, and we need to bring that back.
But
And
we
there's
do
going
need
to
to-
be,
I totally
and there's
agree with
going to
that.
be more capital required in the banking industry, not less going
I know.
forward.
But this is a country where the greater the risk, the greater the reward, and we all know that we have to take some risks because what we are doing today doesn't really work right now. So there has to be some risk element to stimulate our economy and get that morale back, get that confidence back, and get people back to work, which is the real issue.
But Jim, they're making a great point.
They are.
Again, the legislation is suppressing what we'll call entrepreneurial growth.
Then maybe government is just too darn big.
No question.
Maybe
No
it's just too darn big, and it's like herding a herd of elephants with your two hands. Not going to happen. Maybe we should really think about other alternatives in that regard.
So since we've spent 30 minutes on this, we will have to come back in 2011 and speak about it again.
We'll be
And
held accountable at some time in
you'll
2011.
always be held accountable
Okay.
in 2011. But I really appreciate the group today. I'd like to thank Gino Martocci, Joe Grano, Scott Shea, and of course, Jim Orfanidi. See you next week.
Thank you.
Major funding for this program has been provided by grants from Bank of America, Merrill Lynch, and Perfect Building Maintenance, New York Community Bank, All Nation Renovation, Kilroy Architectural Windows, New York's Window Company, Greenberg Traurig, LLP. Additional funding has been provided by grants from AVR Realty Company, LLC, Briarwood Organization, Capital One Bank, C.B. Richard Ellis, Cushman & Wakefield, Dime Savings Bank of Williamsburg, Eastern Consolidated, Hal Fettner, Durst Fettner Residential, Stephen Napolitano, First American Title Insurance Company, Friedman, LLP, Gemini Real Estate Advisors, LLC, Genova, Burns and Gian Tomasi, Grubb and Ellis, Investors Savings Bank, Jack Joffa and Associates Real Estate Consultants, James D. Kuhn Real Estate Institute at Syracuse University, Madison Realty Capital, Markham, LLP, Marcus and Millichap Real Estate Investment Services, Margolin Weiner and Evans, LLP, Massey Knackle Realty Services, M&T Bank, Meridian Capital Group, the Moynihan Group, Newmark Knight Frank, Orphanides and Associates, Siami Development, Inc., SJP Properties, Sterling and Sterling Inc., RAL Companies and Affiliates, LLC, Spandrel Property Services, Urban American.